If you're holding gold right now, what I'm about to show you changes everything. The Federal Reserve just made a move that's sending shockwaves through the precious metals market, and most investors have no idea what just happened or what it means for their wealth. Let me be direct with you. The Fed just signaled a dramatic slowdown in rate cuts for the coming year. They're projecting fewer cuts than the market expected. And here's what's fascinating. Gold initially dropped over 2% on this news, falling to a one-month low. The mainstream narrative? Higher rates are bad for gold. Case closed. But here's where it gets interesting. Because while everyone's focused on that initial reaction, something far more significant is unfolding beneath the surface. Something that could make this Fed announcement the catalyst for gold's next major move higher. Let me explain what's really happening here. When the Fed signals it's keeping rates higher for longer, the conventional wisdom says gold should suffer. After all, higher interest rates mean higher opportunity cost for holding a non-yielding asset like gold, right? That's what they teach in Economics 101. That's what every financial commentator is repeating right now. But here's what they're missing. Here's what the data actually shows when you dig deeper. Gold just crossed $4,000 per ounce. Let me repeat that. $4,000, despite rates being relatively high compared to the previous decade, despite the Fed keeping policy restrictive, despite everything the textbooks say should be crushing gold prices. This isn't supposed to happen. This is what market analysts call a decoupling. Gold is breaking free from its traditional relationship with interest rates. And when you understand why this is happening, you'll see why the Fed's latest move might actually be the trigger for gold's next explosive leg higher. Let's start with what the Fed actually announced. They cut rates as expected, but here's the critical part. They dramatically reduced their projections for future cuts. The market was pricing in multiple rate cuts throughout the coming year. The Fed just threw cold water on that expectation. Now, here's where most people stop thinking. They see fewer rate cuts and assume that's bearish for gold. But let me show you what's really driving gold prices right now, because it has almost nothing to do with short-term rate movements. Central banks are accumulating gold at the fastest pace in decades, not slowing down, not pausing, accelerating. The People's Bank of China has been adding to reserves month after month. The Reserve Bank of India is buying, Poland is buying, Singapore is buying, Turkey is buying. Even countries you wouldn't expect are quietly building their gold reserves. Why? Because they understand something that the mainstream financial media isn't telling you. The global monetary system is undergoing a fundamental transformation. We're watching the slow-motion collapse of the post-1971 dollar-centric order, and the Fed's decision to keep rates higher for longer? That's actually accelerating this process. Here's how. When the Fed keeps rates elevated, it puts enormous pressure on the rest of the world. Countries that borrowed in dollars now face crushing debt service costs. Emerging markets are getting squeezed. Even developed economies are feeling the strain. And what's their response? They're diversifying away from dollar dependence. They're building alternative payment systems. They're settling trade in local currencies. And they're buying gold as a neutral reserve asset that no single country controls. The BRICS nations just announced plans to expand their economic cooperation. They're not explicitly creating a gold-backed currency like some headlines suggest, but here's what they are doing. They're building infrastructure for trade settlement that bypasses the dollar, and gold is playing a central role as a trusted store of value in this new architecture. Think about what this means. The Fed can keep rates high. They can signal hawkish policy. They can try to support the dollar through tight monetary policy. But every day they do this, they're giving the rest of the world more incentive to find alternatives to the dollar system. It's like watching someone try to hold a beach ball underwater. The harder they push, the more pressure builds. And eventually, something's got to give. Now let me show you something fascinating in the technical picture. Gold's pullback after the Fed announcement, it took prices down to a level that's been tested multiple times as support. We're talking about a zone where massive buying has consistently emerged. Institutional buyers, central banks, and sophisticated investors have shown they view any dip to these levels as a buying opportunity. Look at the pattern over the past year. Every time gold has pulled back on Fed-related news, it's been bought aggressively within days or weeks. The dips keep getting shallower. The rallies keep reaching new highs. This is classic accumulation behavior. And here's what really tells you something. Gold mining stocks didn't collapse on this news. They pulled back, sure, but nothing like the panic selling you'd expect if smart money thought this was the end of gold's bull market. The miners are holding up remarkably well. which suggests institutional investors see this as a temporary shakeout, not a trend change. Let me take you back to a similar moment in history. In 1980, gold hit its previous all-time high around $850 per ounce. Then it entered a brutal 20-year bear market. Why? Because Paul Volcker jacked interest rates up to nearly 20% to crush inflation. The opportunity cost of holding gold became astronomical. Money flooded into bonds and cash. But here's the critical difference between then and now. In 1980, the dollar was still the undisputed global reserve currency. There were no alternatives, no competing payment systems, no coordinated effort by major economies to reduce dollar dependence. The Fed could raise rates, and the whole world had to accept it. Today? Completely different landscape. The Fed raises rates and countries start asking, why are we subjecting our economies to American monetary policy decisions? Why don't we have more options? That's the question driving central bank gold buying. That's the question behind the BRICS expansion. That's the question that makes this Fed announcement potentially bullish for gold, not bearish. Now, let me address something important here. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings with precious metals. But back to what's happening right now with the Fed and gold. Here's another piece of the puzzle most people are missing. The Fed is signaling fewer rate cuts because inflation isn't cooperating. They're seeing persistent price pressures that won't go away. Energy costs remain elevated. Food prices are sticky. Housing costs continue climbing. Now think about what that means. The Fed is essentially admitting they can't get inflation back to their 2% target without keeping policy restrictive for longer. But here's the problem. They also can't keep policy restrictive indefinitely without breaking something in the financial system or the economy. We're already seeing stress in commercial real estate. Regional banks are still dealing with unrealized losses on their bond portfolios. The federal government is paying over $1 trillion per year just in interest on the national debt. Every month the Fed keeps rates high. These pressures intensify. So the Fed is trapped. They can't cut rates aggressively because inflation is still too high. But they can't keep rates elevated indefinitely because the debt burden becomes unsustainable. This is exactly the kind of environment where gold thrives. Gold doesn't need rate cuts to go higher. What gold needs is uncertainty about the Fed's ability to manage the situation. What gold needs is questions about the long-term stability of the monetary system. What gold needs is investors realizing that maybe, just maybe, the people in charge don't have this all figured out, and that's exactly what this Fed announcement is creating. Not confidence, uncertainty. Let me show you what's happening in the physical gold market, because this is where the real story is unfolding. Premiums on physical gold coins and bars remain elevated. Delivery times from major dealers are extended. The spread between paper gold prices and physical gold prices keeps widening. This tells you something crucial. There's a disconnect between the paper market, where prices are set, and the physical market, where actual metal changes hands. When you see gold prices drop on Fed news, that's largely a paper market phenomenon. Futures contracts being sold, ETF shares being liquidated. But in the physical market, buyers are stepping in. Think about what that means. The price discovery mechanism is breaking down. The paper market is saying gold should be lower because rates are staying high. But the physical market is saying, we'll take all the gold we can get at these prices. Which market do you think ultimately determines the real value? The paper contracts that can be created with a few keystrokes? Or the physical metal that takes months to mine, refine, and deliver? Here's another angle to consider. The Fed's decision to keep rates higher for longer is going to put enormous pressure on the U.S. government's fiscal situation. We're already running massive deficits. The interest expense on the national debt is exploding. And now the Fed is saying rates are staying elevated. How does this get resolved? Either the government has to dramatically cut spending, which seems politically impossible, or they have to dramatically raise taxes, which also seems politically impossible. Or the Fed eventually has to step in and monetize the debt, which means printing money to buy government bonds. That third option? That's the one gold investors are betting on. Because when the Fed eventually has to choose between letting the government default or firing up the printing press, we all know which option they'll choose. They've told us as much. They've said the government's debt is backed by the full faith and credit of the United States. And what does that really mean? It means the Fed will print whatever money is necessary to prevent default. So when you see the Fed signaling fewer rate cuts, don't just think about the immediate impact on gold prices. Think about what it means for the long-term fiscal trajectory. Think about what it means for the dollar's purchasing power. Think about what it means for the inevitable return to monetary expansion. Now let's talk about what's happening in the gold mining sector, because this gives us important clues about where prices are headed. Major mining companies are reporting that it's getting harder and more expensive to find new gold deposits. The easy gold has been mined. New discoveries are in more remote locations, deeper underground, in more challenging geological conditions. What does this mean? It means the cost of producing gold is rising. And when production costs rise while demand remains strong or increases, what happens to prices? They have to go higher to incentivize new supply. But here's the kicker. Even with gold at $4,000 per ounce, many mining projects still aren't economically viable. The permitting process takes years. Environmental regulations are getting stricter. Local communities are demanding more benefits. The timeline from discovery to production can be a decade or more. So, we have a situation where demand is strong and growing, particularly from central banks. Supply is constrained and getting more expensive to produce, and the Fed is creating conditions that make alternative reserve assets more attractive. This is a recipe for much higher gold prices, regardless of what happens with short-term interest rates. Let me paint you a picture of what could unfold over the next year. The Fed keeps rates elevated, trying to control inflation. This puts pressure on the economy. We start seeing cracks in the financial system. Maybe another regional bank fails. Maybe commercial real estate losses force a major institution to take write-downs. Maybe the stock market corrects sharply. What happens then? The Fed has to choose. Do they stick with their hawkish stance and risk a full-blown financial crisis? Or do they pivot back to accommodation, cutting rates and potentially restarting quantitative easing? Either way, gold wins. If they stay hawkish and something breaks, gold becomes the safe haven as confidence in the financial system erodes. If they pivot to accommodation, gold rallies on the return of easy money and concerns about currency debasement. This is what's called an asymmetric opportunity. The downside is limited because gold has strong support from physical buyers and central bank accumulation. But the upside is enormous because we're potentially at the beginning of a major monetary regime change. Think back to 2008. Gold was around $800 per ounce when the financial crisis hit. The Fed slashed rates to zero and launched quantitative easing. Gold went on to nearly triple, hitting $1,900 by 2011. And that was with the dollar still firmly entrenched as the global reserve currency. Now imagine what happens in an environment where the dollar's reserve status is being actively challenged, where central banks are diversifying reserves, where alternative payment systems are being built, where the fiscal situation is far worse than it was in 2008. Where the Fed's balance sheet is already massive and their tools are more limited. The potential move in gold could dwarf what we saw in the 2008-2011 period. We're not talking about a triple. We could be talking about gold at $6,000, $8,000, even $10,000 per ounce over the next several years. And here's what makes this Fed announcement so significant. It's confirming that we're in a new paradigm. The old playbook doesn't work anymore. The Fed can't just cut rates and solve every problem. They're constrained by inflation. They're constrained by fiscal dominance. They're constrained by the loss of dollar hegemony. Let me show you what's happening in the options market, because this is where sophisticated traders place their bets on future price movements. Call options on gold, which profit from rising prices, have seen strong demand even after this Fed-induced pullback. Put options, which profit from falling prices, aren't showing the kind of activity you'd expect if smart money thought gold was headed significantly lower. This tells you that institutional investors and hedge funds aren't convinced this pullback is anything more than a temporary shakeout. They're positioning for higher prices ahead. And look at what's happening with gold ETFs. Yes, there's been some outflow, as retail investors get scared by headlines about the Fed staying hawkish. But the really large institutional holders, they're not selling. In fact, some are adding to positions on this dip. This is classic smart money behavior. Let the retail investors panic, sell on the news, accumulate their shares at lower prices, then ride the next leg higher when the narrative shifts. Now, let's talk about what this means for silver, because silver often amplifies gold's moves. Silver has both monetary and industrial demand. It's used in solar panels, electronics, electric vehicles, and countless other applications. As the green energy transition accelerates, industrial demand for silver is surging, But silver also tends to follow gold during monetary crises. When investors lose confidence in fiat currencies, they buy both gold and silver. And because the silver market is much smaller than the gold market, the price moves can be more dramatic. If gold is setting up for a major move higher, silver could absolutely explode. We're talking about potential moves that could take silver from its current levels to $50, $75, even $100 per ounce if we see a real monetary crisis unfold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently elevated by historical standards. This suggests silver is undervalued relative to gold. When this ratio compresses, as it typically does during precious metals bull markets, silver outperforms gold dramatically. So this Fed announcement that's causing short-term volatility in gold, it could be setting up an even more explosive move in silver. Let me bring this back to the bigger picture. We're living through a historic transition in the global monetary system. The Bretton Woods system collapsed in 1971 when Nixon closed the gold window. What replaced it was a pure fiat dollar standard, backed by nothing but confidence in the U.S. government and economy. That system worked for 50 years, but it's breaking down. The U.S. has abused its privilege as the reserve currency issuer. We've run massive deficits. We've weaponized the dollar through sanctions. We've printed trillions of dollars, and now the rest of the world is saying enough. The Fed's decision to keep rates high is accelerating this breakdown. Every country that gets squeezed by high dollar interest rates is one more country looking for alternatives. Every business that struggles with dollar funding costs is one more business open to settling trade in other currencies. And gold? Gold is the ultimate alternative. It's no one's liability. It can't be printed. It can't be sanctioned. It's been money for 5,000 years. When confidence in fiat currencies erodes, gold is where wealth flows. This is why central banks are buying. This is why sophisticated investors are accumulating. This is why the physical market remains tight despite paper market volatility. Everyone who understands monetary history knows how this story ends. The question isn't whether gold goes higher. The question is how high and how fast. And the Fed's latest move, ironically, might be the catalyst that accelerates the timeline. Here's what you need to understand about market psychology right now. The initial reaction to Fed news is almost always driven by algorithms and short-term traders. They see hawkish Fed, and they sell gold. It's a knee-jerk reaction based on outdated correlations. But within days or weeks, the smart money steps in. They analyze what the Fed announcement really means for the long-term trajectory of monetary policy, fiscal sustainability, and dollar dominance. And they reach a very different conclusion than the algorithms. This is the pattern we've seen repeatedly over the past few years. Fed announces something hawkish. Gold drops. Then gold quietly grinds higher over the following weeks and months, eventually making new highs. Why? Because the fundamental drivers of gold's bull market haven't changed. If anything, they're getting stronger. Let me give you some specific levels to watch. Gold has strong support in the zone where it pulled back after the Fed announcement. If that level holds, which the physical market activity suggests it will, we could see a rapid recovery back toward the recent highs. A break above those highs would likely trigger a surge of momentum buying, potentially taking gold to $4,500 or even $5,000 relatively quickly. On the downside, a break below the current support zone would be concerning and might lead to a deeper correction. But given the strength of physical demand and central bank buying, that scenario seems less likely. The buyers keep showing up at these levels. For silver, watch the $28 to $30 zone. That's been a key battleground. A decisive break above $30 could trigger a rapid move toward $40. Silver tends to move in explosive bursts during precious metals bull markets, and we could be setting up for one of those moves. Now, I want to address something important. Some people will say, gold has already gone up so much. Isn't it too late to buy? Let me show you why that thinking is flawed. In 2009, gold was around $1,000 per ounce. People said it was too expensive. It went to $1,900. In 2019, gold was around $1,400. People said it had already had a big run. It went to over $4,000. The point is, during a major bull market driven by fundamental monetary changes, trying to time the perfect entry is less important than just being positioned. Yes, you might buy and see a pullback. But if the thesis is correct and gold is headed to $6,000, $8,000, or $10,000, does it really matter if you bought at $4,000 or $3,800? The bigger risk isn't buying too high. The bigger risk is not being positioned at all when the next leg of this bull market unfolds. Because when gold really starts moving, when the monetary crisis becomes obvious to everyone, you won't be able to get physical metal at any reasonable price. Premiums will explode. Delivery times will stretch to months. Dealers will struggle to source inventory. That's what happened in 2020 when COVID hit and people suddenly wanted physical gold and silver. Premiums went to 30, 40, even 50% over spot prices. You couldn't find metal. And by the time supply normalized, prices were much higher. The time to position yourself is before the crisis becomes obvious to everyone. The time to buy insurance is before your house catches fire. And right now, while everyone's focused on the Fed's hawkish rhetoric, might be exactly that moment. Let me leave you with this thought. The Fed just told you they're keeping rates higher for longer because they can't control inflation. They're admitting their tools aren't working as planned. They're signaling that the economic situation is more challenging than they expected. And the market's initial reaction was to sell gold. Think about that. The Fed admits they're struggling to manage the economy and inflation, and people sell the one asset that's designed to protect against exactly that scenario. This is what creates opportunities. When the crowd zigs, sometimes the smart move is to zag. When everyone's selling because of short-term rate concerns, maybe that's when you should be buying because of long-term monetary concerns. The Fed's move isn't the end of gold's bull market. It might be the beginning of the next explosive phase. Because every day they keep rates high while inflation persists. Every day they squeeze the global economy. Every day they force other countries to seek alternatives to the dollar system. They're building pressure that will eventually have to release. And when it does, gold is going to be the release valve, the safe haven, the alternative, the asset that's no one's liability and can't be printed away. So if you're holding gold right now, don't let short-term volatility shake you out. Understand what's really happening beneath the surface. Understand why central banks are buying. Understand why the physical market remains tight. Understand why this Fed announcement, despite the initial price reaction, might actually be confirming the bull case for gold. The system shock isn't the Fed's hawkish stance. The system shock is what happens when the world realizes the Fed's hawkish stance is unsustainable, and the only way out is through currency debasement. That's when gold really moves, and we might be closer to that moment than most people think.